Welcome to the Money Show in historic downtown Philadelphia, Pennsylvania. I'm John Dobis from Forbes, joined by Stephen Schork of the Schork Report. He's an energy guy, publishes a newsletter. How frequently?
Every day.
Every day. Okay, so you've got a lot to talk about with the oil prices spiking and then coming back down. But one of the big themes, it looks like, natural gas has had a tough time. Why?
Yes. Well, natural gas is the longest long-term bull market that's waiting to develop. That is to say that as we steer the economy away from oil, natural gas is the commodity we are feeding into. But the situation here in Philadelphia, in the western part of our state, eastern part of Ohio, is the amount of gas. We are producing a prodigious amount of gas. We simply don't have the takeaway capacity or the demand yet. So we are right now in the process of developing those markets. First, the takeaway capacity, that is the pipelines to get it out of Pennsylvania, out of Ohio, out of Appalachia. Get it to the export markets down in the Gulf Coast, get it to the demand centers. That's all in development right now. We're still a few years away, so natural gas is a perpetual, at this moment, bear market, but long term, probably 10 years, probably my best bull market opportunity right there.
So very few people go out and say, hey, let's go drill for some natural gas. Doesn't most of it come up coincidentally when you drill for oil as a byproduct that's either flared off and wasted, or if they have a pipeline nearby, they can sell it? Is that?
Well, it all comes down to the geology. So here in Pennsylvania, it's gas. It's gas-rich deposits, and that's the problem.
They're going for gas.
They're going
Okay.
for gas, and they've been going for gas. Unfortunately for them, they've gone for too much gas. We have too much, don't have the pipelines. But in West Texas, you have oil production, and then you have a lot of gas as a byproduct that comes up with that production. That is associated gas. So we're in a scenario where a bullish scenario for oil, I want to take more oil out of the ground, is actually bearish for natural gas, because the more oil I take out of Texas, the more gas I'm getting.
The more free gas.
And that's just
bad.
it. And we don't
so
have
I like what you said before. It's a long-term bull market in development, meaning it's got some issues.
It still has to mature.
All right, well, I know just having the pipeline infrastructure to move it is essential, and I know I live in New York State, and there's political battles about, I don't know who it is, Enbridge or Plains All Americans trying to put a pipeline through there, and it's tough.
It's that NIMBY crowd.
Longer term, there was a feverish intensity. If there was a big picture out of the Iraq war that going to war in Iraq would incentivize domestic production, I guess it worked out pretty well, because we were like a 6 million barrel per day producer. The U.S. I'm speaking of was it's about 5 million, I think, before the Iraq war, 2001, 2002. Now we're at 10 plus million per day, putting us in the lead, not by much, but it's like a three-man game. U.S., Saudis, and Russia. This is a whole different ballgame politically, right, than the last three-quarters of a century, where we had Russia effectively out of the oil market, and Saudis became our best buddies after we left the gold standard. The petrodollar system. I'm going a little bit too far here, maybe. I don't know, but it's all a big picture thing, because the Saudis agreed to sell oil for dollars. That helps our currency.
Brings the investment back.
By the way, those profits you make, could you put them back into our government debt market?
That's what happens.
And that's why we're able to give out slips of paper and get back TVs.
Yeah, indeed. And that's all changing. And what the heart of this is the fallacy of peak oil. Now, there was this assumption that we weren't finding any oil, but I tell you what, when oil averaged $17 a barrel in the 1980s, $19 a barrel in the 1990s.
Nobody wanted to find oil.
We didn't find oil, right. We always knew.
Not out there.
Right, we always knew there was more oil in the Saskatchewan Plain, North Dakota, up into Canada than there is on the Arabian Peninsula. We've always known that. The geologists have known that. But the economics never worked. I tell you what, you drive oil from $20 a barrel to $150 a barrel, you all of a sudden find a lot of oil.
A lot of people in the oil business after that.
And so, but it's a boom and bust. So we had that huge surge in production. To your point now, the United States is now the 900-pound gorilla in this market, and it is clearly affecting both the petrodollar, so what we have to do to finance our long-term debt with the decline of the petrodollar, for instance, and also the instability that this is creating, because we have a lot of economies in South America, in West Africa, and in the Middle East that are depending on higher oil prices.
Iran is,
and where are all the troubled hotspots right now?
Nigeria.
All oil-producing countries, and you cut off that paycheck, and when you take a haircut from $70 to $80 barrel oil to oil that's perpetually in that $50 to $60 range, that's a big hit to the bottom line for these economies.
Desperate things, yeah. See how oil really affects your life in just about every way imaginable?
Indeed.
I mean, it's not just when I was a kid, the price of oil went down, lower gas prices. And I kind of still say that because I pay for the gas now. But But you can see that higher oil historically is correlated well for the United States of America.
Well, indeed, especially now with oil and production in this country being such a big driver. And when you talk about high oil prices, that's a pet peeve of mine, because we're looking here at, let's say, gasoline at the pump, $3 a gallon. That is considerably cheaper today than it was in 1981.
I remember paying $5 in the Iraq war times.
But in even in the early 1980s,
when indexed for inflation,
when gas was $1.90, that's $4 today.
Right.
And so, what commodity out there that is only increased in demand over the last 2 generations, its access to that commodity has been cut, and yet it's cheaper today than it was.
You're right.
Capitalism, economics, it works. Let's just that's your key takeaway here.
Capitalism, economics, it works. Oil, big drama. One more thing before I let you go. We're up there neck and neck with Russia and Saudi Arabia production-wise, but our proven reserves are nowhere near what Saudi has.
Right.
So, can we keep at this? Can we keep at this pace of 10? I mean, if we don't start strip mining underneath Independence Hall, I mean.
Well, I tell you, with all reasonable estimates, the United States is a powerhouse in the oil producing, but that's going to be short-lived. 10 years by all reasonable estimates. But I tell you what, with the way, especially this younger generation, they're complete discomfort,
distaste for petroleum.
For petroleum. Right. 10 years is going to be enough, and I think we'll transition out of it when the demand cycles have moved and this next generation has moved up and is now calling the shots.
I'd be curious to see how we're going to heat our homes and move our transportation at 2119.
Indeed.
Stephen Schork, Schork Report.
Thank you.